We're now going on to a panel that I've really been looking forward to, the panel on retail. It's being moderated by Josh Sussberg, who over the last year or two has become really one of my new heroes in the bankruptcy practice. He's been involved with just about everything, and in particular has been in the middle of just about every major retail case, including, I guess we have to congratulate Josh for getting JCPenney to a confirmation last week, and as a number of your panelists have done. He's been involved with everything from Tailored Brands, Stage Stores, Pier 1, Forever 21, Barney's, Toys R Us, etc. So he and his panel have seen it all. So let me turn it over to Josh to conduct and introduce the panel.
All right, thank you, Harold. Much appreciated. And it's good to have this opportunity today. When we were putting this panel together, I think the goal was to get a wide, diverse group of folks from all perspectives in the restructuring arena. And so we wanted to cover both legal, financial, the investing, and the operational. And I am pleased that we're able to have a great panel of folks here today. I'm just going to go in order. Krista Hart, who's an MD at FTI and a specialist in the retail landscape and has a ton of experience on the operational side of things and with restructurings more specifically. Michael Neruda, who's a partner at TSSP and is involved on the investments in many different retail companies, most notably and most recently, JCPenney and Neiman Marcus, plus many, many others over the last several years. So he'll have a very interesting perspective into how you actually make money in retail these days, notwithstanding everything that we're dealing with. And then Julia Frost-Davies, who's a partner at Morgan Lewis and is on the lending side of the practice and is frequently representing ABL, term loan lenders, DIP lenders, you name it, in many of the retail cases that have been out there and in the headlines today. So I welcome all of our panelists and appreciate you guys taking the time. Getting right into it, and we've got a couple different sets of questions with some themes that'll play upon each of our experts' expertise. But I'm going to start with Julia, and just at a high level, Julia, can you explain, from your perspective, being on the side of the financing world, how are companies going about obtaining financing in this ever-changing retail market? And what are the types of financings that we're seeing, and how are people getting creative to ensure that there's adequate liquidity for these situations to give them a chance to restructure?
Yeah, Josh, thank you, and good afternoon, everyone. So I think you start by thinking about what assets does your typical retailer have available to secure liquidity. So you'll have your working capital assets, your inventory, your AR, sometimes, but not generally, owned real estate. You may have some that is a distribution center, headquarters. There are some retailers, although not that many, that actually have a significant amount of owned real estate in their portfolio. Leasehold interests, intellectual property, which is increasingly serving as a basis for liquidity, and your FF&E, not generally your primary source. And you think about what kind of investors are going to look to each of these assets. So a revolving credit facility, for example, might be supported by the working capital assets. So you'll see inventory and the AR sitting in that facility. Those are typically going to be your large national banks. You may have other participants from around the country. And the benefit of having banks in that position is that you can have letters of credit that can sit within the facility. Cash management services are often provided by one or more of the lenders, and they'll be agented by a primary lender. But often, in order to raise the liquidity for retailers of the size that Josh and others represent, it does take a village. So you'll have a large group, so there's enough to go around. I don't know if everyone, I'm sorry, needs to mute. We're getting a bit of an echo, but the intellectual property may serve as primary collateral for term loan lenders, you're seeing this in high yield financings now as an additional source of liquidity. You'll often see, Josh, are you on mute?
I am, maybe not.
Okay. Great. Thank you so much. Sorry for that. I want to hear everything you have to say, but I just don't want to hear the echo. So thank you for that. So the intellectual property, the FF&E, the real estate may serve as primary collateral typically for your high yield investors, for secured senior notes, term loans, and then you'll often see intercreditor arrangements that have crisscross liens. So you'll have priority collateral being the working capital assets primarily for the asset-based revolver lenders, and then the others for the high yield with junior liens on each other's collateral. So if you think about how you're going to determine the advance rates under your working capital facility, which really is going to be the cornerstone of the liquidity for any retailer, how they actually manage their cash on a daily basis, that's done by having a third-party appraisal of the net orderly liquidation value of the inventory, so the NOLVs. And what you're thinking about from an investment thesis is if every plug got pulled tomorrow and you had to liquidate the collateral, if you're thinking about it from an ABL perspective, how are we in the box and how will we come out whole? So the thought is you take the time within which it will take to liquidate the collateral in place in the stores, because no one's really backing up trucks to take T-shirts to sell on the corners these days or any day. And what is that value going to be? And then the lender and borrower are able to calculate the advance rates that are going to be available to drive that liquidity. So Josh, you had asked how had some of this changed post-pandemic, and I think a few things. So one is there are a lot of creative guys out there. Mr. Sussberg is one of them. And I think in Q1 and early Q2, there were a lot of offensive draws on revolvers in large amounts. So there were companies, including many whom he represents, entering bankruptcy with more liquidity and cash on hand than one would typically see in a failed retail situation or distressed retail situation. So one result of that has been a market correction, as there often is, through the amend and extend and forbearance period that we saw in Q2, Q3 of anti-cash hoarding provisions and things that might put some reserves and other abilities and guardrails around some of that borrowing. I'm not sure that's necessarily going to hold in the new deals going forward, but at least in some of the forbearance and amend and extend periods, we did see that. You also did see the IP serving as a basis for generating additional liquidity. I don't know if the increase in IP value is driven solely by the reliance on e-com and the fact that a lot of the marketing, as we all know and we'll talk about, and the activity is happening on the online platform, or if it's also just a little bit of a shift in relative value, where IP might ordinarily have been seen as boot collateral and now is seen as something that is much more valuable. Another trend we're sometimes seeing is it's new, I think, take the IP and segregate it out into an IP co and not lean it up, and then have your assets sitting at your opcos with, of course, you'll need agreements for right to use, because you can't sell your inventory without being able to brand it and go through that intellectual property. So, Josh, that's some of what we're seeing out there now. I think that as we're seeing exits, they're trending in a similar way. And right now, the high yield markets, I think, are much more active than they will be coming up towards the end of the year. So we're definitely seeing activity there.
That's helpful. And I think that's a pretty good segue to Michael. So, Michael, you guys are active in various different ways from an investment standpoint. Obviously, there's distressed debt in companies that have multiple tranches. But I know you guys have also been active in the first out market, right, where you put in some capital behind the ABL and maybe take a first lien on everything that's uncovered, including the IP. So how do you go about thinking and assessing, the value proposition and where it is that you want to play in a capital structure?
Yeah, thanks, Josh. So we're a bit different than most investment firms. We can originate financings, we can do secondary purchases, buy assets, start new companies. What we're really just looking for is good companies, assets, and management teams. So as you mentioned, we have an industry-leading retail ABL practice, and we finance many retail businesses on the direct lending side. And we also have a business that invests in the public markets, which is what I focus on. So what we're looking for across any of these opportunities is industries that are undergoing change. And to us, that's what creates the opportunity. And obviously, retail is undergoing a lot of change. In retail, what we're looking for specifically are companies or assets that can withstand that change. And so, we met, Julie already mentioned looking at brand and IP value. We look for value of real estate collateral and how that value is being utilized or not utilized on the company's balance sheet. We're looking at the value of inventory and other assets. And then finally, we're looking for good management teams with a smart, thoughtful, forward operating business plan. So, ultimately, this has allowed us to invest in companies like Neiman and JCPenney, and the fact that they have assets, a strong set of assets, whether that's real estate, intellectual property, or inventory, that has allowed these companies to reorganize because it provides them options, and it allows third-party buyers and other capital providers to come in and execute on their business plans.
That's great. Thank you, Michael. And I actually think, right, so we're talking about how to finance these companies, but, Krista, and you're seeing this and you're on the front lines, there's just been so much change over the last 5 years in retail. And obviously there's the Amazon effect, and we're sitting here and it's Cyber Monday and hopefully everybody's buying lots of stuff online. But it was like one of the worst Black Friday from a traffic perspective for obvious reasons in the face of a pandemic. But, consumer habits really do drive a lot of these situations. And the change in behaviors is something that's making it hard to get a handle around financing opportunities and restructuring. So could you spend just a couple of minutes telling us, what we're seeing on the consumer side of things and how that impacts everything that we do day to day?
Yeah, thanks everybody. We've been doing some research during the pandemic. We just fielded 2 studies about holiday gift giving. So we've been very curious about what's happening with consumers. I would say the one thing to keep in mind is that the results of the pandemic are not different from things that had been happening over the last 3 to 5 years. So it's an acceleration of change, but it's not really a difference, with one exception. And so let's just talk about the things that have come about with the pandemic. Customers are definitely more value conscious. 64% of them say that they're going to wait till it's at least 25% off before they buy holiday gifts. And about 35% of the people are planning to wait till 40% off. Supporting that, or kind of related to that, they are planning to spend less at department stores and upscale mall specialty stores. And you're going to see that mass merchants and value department stores are going to claim share. And I think it's the appeal there to the COVID consumer who's nervous about safety, wanting to have one-stop shopping. So I do think you're going to see some big gains in Walmart, the Walmarts and Targets of the world. Like most of us, they plan to spend less on apparel, both in general and for gifts over the holiday, and jewelry and accessories they also are planning to spend less on. So I think that this whole looking at everybody, with the exception of Josh, who's wearing a suit jacket, most of the rest of us have changed the way that we dress, and that's true of consumers, and they are not necessarily expecting that to change. They're planning to buy more online, and that's obvious after what we saw over Black Friday. But 79% of customers said they're going to buy more online, and 34% of people, and this is across nearly every age group, is planning to spend at least 80% of their holiday shopping online. And so that's a very big number, and that's true across all of the different generations. It varies slightly, but in a very small way. And so I think we can expect to see those big trends continue at least through most of 2021.
That's super helpful. Thank you, Krista. So, Michael, I'm going to come back to you on a relatively hot topic. And I don't know if this is necessarily specific to retail, but it's certainly something that's become more prolific over the last couple of years. And that is, special type of financing arrangements led by a majority of lenders that don't necessarily include everybody in a single tranche. And, this is different than 10 years ago when we had a first lien and a second lien and intercreditor arrangements that governed people's behaviors and actions. This is within an existing credit facility and amongst the lenders. How do you think about, those dynamics, and making sure that you're positioned to, be in the group, so to speak. And when you're in that group, how do you think about it from the sense of moving a case forward and trying to get something done when at the same time looking at economics and wanting to make a recovery?
Yeah, so Josh, as you said, I think this is one of the hottest topics in credit right now, whether it's outside of bankruptcy as a way to extend the company's runway or inside a bankruptcy as a way to move the case along. But, from our perspective, this is really nothing new. It's just another tool in the issuer and the company advisor's toolkit here. A few years ago, everybody was talking about the J.Crew trapdoor. Then it was the Chewy transaction, unrestricted subsidiary distributions, and now it's open market repurchases and subordination. And I was just reading, there was a covenant review article that said 94% of loans that they reviewed, majority lenders can subordinate minority lenders. So I think this is something that, will continue. But this is a continuation of a trend that's been going on for a while now, and that's making loans at new issue look a lot more like the bond market. And a lot of these issues and deficiencies already exist in the bond market. So, understanding how the dynamics work among different stakeholders, not just lenders, but the company and advisors or sponsors, this is obviously very important. And I don't think it's specific to retail. I think you see it in any industry right now. And, for us, from an investment perspective, it's always fact dependent, and, it's hard to kind of generalize here, but because it is so fact dependent, we need to be very careful to read all of the documents, analyze, with people like those on the phone here, and counsel to really understand, the different permutations and what can happen to your investment. And, throughout it all, we try to just do our work and stay even keeled about it. And, there's a lot of noise around these types of situations, but, it also creates interesting investment opportunities.
And Julia, a question for you. You're more typically representing the agent and the big bank lenders that are, part of the ABL. But, how do you think about these intra-lender dynamics from an agent position? And, how does the agent take a position, vis-a-vis the group, the minority, the majority, whatever it may be?
Yeah, so Josh, it's a great question. And one of the interesting things about retail lending, particularly, is that it's a very specialized and nuanced area. So you're going to see repeat players. So if you're the agent on one deal, you may be in the group on another deal. So I do think that agents are always cognizant about the fact that what's sauce for the goose may come back around, right? So there's sometimes talk within groups about, if you have holdouts, let's say you have a pre-petition asset-based lending facility, the agent and a majority of the lenders want to provide debtor in possession financing, and there's holdouts. Then you have to have the conversation about how you deal with that. And of course, the first place you look is in your documents, but the next place you look is in relationships and thinking about the precedent that you're going to be setting for the next deals down the road. And they're almost always actually resolved in a way that is constructive. It's a little easier when you're moving from a debtor in possession facility to an exit, because that's really a new credit, and so people can participate or not as they like. But I'm not going to tell you there aren't differences of opinion among a bank group, but strong agents and all of the players out there right now are, on the national banking side, are very strong agents, know how to work within that to do what's best for them. They all do have a common lending thesis when you're looking at the asset-based lending side, as opposed to what Michael's talking about, where people may be buying open market and something that looks more like a term loan or senior secured notes. And you're not necessarily, you may have, par players, non-par, open market, people who want to loan to own, people who want to backstop into an exit or a dip, and others who don't. So I think you're not going to see on the revolver ABL side as much of a difference in your ultimate goals, although you may have some negotiating and some differences of opinion in how to get there.
Got it. So Krista, question for you. There's a balance sheet side to all of these retail restructurings, but I think everybody ultimately forgets that there's a huge operational side of this too. And many of these businesses have been hampered for the last several years for a whole number of reasons. And the bankruptcy code affords some pretty significant tools for retail companies in particular when it comes to leases and contracts and all of the other operational tools that are available. So in these what have become short-lived cases where costs are extremely high, and there's obviously a balance between administrative burn and all the benefits you can get from the operational side of things, how are you instructing retail companies to be proactive and think about affecting the necessary operational changes to ensure that ultimately when the balance sheet is taken care of, the company can actually perform and thrive go forward?
I think, everyone knows that we have a limited time frame with rejecting leases, and that probably is the number one most important thing that retailers need to consider. And I've never heard a company come back and say, wow, I wish we hadn't rejected so many leases. Generally speaking, people err on the side of keeping too many stores open. And in particular, that's problematic now because we've had several years of declining sales levels. And for many retailers, instead of having groups of really good stores and really bad stores, we have sort of a homogeneous group of really not great stores. And so I think taking a really hard look at those is very, very important. And I've heard a lot when I review business plans, people will say to me, well, if we can just get back to 2018 or 2017 or 2019, I think we have to be very leery about that when we think about business plans going forward. I mean, the consumer has really spoken very strongly about her preferences during this pandemic. And I think we have to assume that the future is in some ways going to be more of the same. And so I think that realistic view about the sales line is probably the most important thing retailers can do. And being very clear about what stores to keep open and taking a portfolio view of a market. Because one of the positive things that I've seen recently is on sales transfer. I think originally people had a relatively simplistic view about what was going to happen when they closed a store. And they thought that most of those sales would just go away or transfer online or to a competitor. But instead, they've been seeing that their customers that do like to shop stores are very loyal, and we have much higher sales transfer rates than we thought. And so being thoughtful about the portfolio of stores in a location, I think, is really, really critical, because I think you can keep more of the sales than you think if you're thoughtful in the way that you view those markets.
Yeah, and your point on the leases is an important one. And, Julia, I know this is a topic near and dear to your heart, right? It used to be that a retail company would hang out in bankruptcy, see 2 holiday seasons, want to determine whether or not things were turning around, make decisions, and reorganize. Then our landlord community went and lobbied very hard to ensure that they have a go or no-go decision on each applicable unexpired lease within 210 days. So from a financing perspective and a lending perspective, that usually tends to lead the direction of the case. And we see that in milestones and the like, because, Julia, to your point, the ABL lenders want to ensure that if, God forbid, they need to get in there and protect themselves by liquidating the collateral, they still have leases. So how do the lenders think about that, and how does that drive all the underlying credit analysis and liquidity profile for all these retail companies?
Yeah, Josh, it's really the number one consideration, right? I mean, as both you and Krista have said, and just to sort of level set for a moment, the bankruptcy code does normally provide for a longer time period, which is up to the time of confirmation for a debtor to make a decision whether to assume or carry on with or to reject, to get rid of a particular lease. It is different with respect to non-residential real estate, which is the majority of your leasehold interests in the retail context. So that starts out with 120 days. with the ability to get an extra 90, which is where Josh is talking about the 210. So one thing that's important, ABL lenders start from the outset, as I said at the opening of this program, by thinking about, if I have to pull the plug, how long will it take, and what's going to be the net orderly liquidation value? So if I need to recover, what's my downside? So you start with that. I've seen it run the gamut. It depends on the retailer. It can be 7 weeks, it can be 11 weeks, it can be 13 weeks that you need to recover. So you take that 210 days as the day by which Josh's clients have to be out of the stores if things go badly, or they have to make that decision. And then you got to back out of that your liquidation profile and say, it's going to take me 11 weeks. So I'm at, T210 minus my liquidation period. And that's when you're thinking, I got to make a decision, as Josh says, on go or no go. Is this really a reorg? And then if you start to bleed into that time period, you're really imperiling your underlying investment thesis. And you can couple this with the fact that some of the inventory hasn't held value, let alone increased in value during COVID. It's aging in place. Sometimes companies can't even get into their stores. So even if they are open and you have reduced foot traffic, it's just not necessarily holding the value. So it's certainly top of mind and thinking about, we don't want to go the other way, but if I have to, what kind of timeline will that take? That's why retail cases are so accelerated. And I know a lot of matters that Joshua and I have worked on together comes in with an exit strategy. It's like, okay, there's a lot of work done more now than maybe there used to be about knowing where you're going to go before you get there. You don't see the free falls unless it's, a complete crisis. You come in with maybe a term sheet, a restructuring support agreement, and a timeline to try to get there because you're going to be under the gun with respect to getting in and out of these leases. Now, it's interesting, though, because a lot of the landlords don't want you to reject their leases, right? That's their entire investment thesis, is they've got a tenant, they've got an ongoing source of revenue stream. And so as you worry about some of the rejections, you're also seeing landlords form joint ventures to actually come and rescue a retailer because they don't want all these boxes to go dark. And then once they control part of the go-forward entity, they have leverage with respect to deciding which stores are going to close, and those that are outside of their own portfolio may have reduced negotiating leverage.
So, Michael, just on this point and leases and operations more generally, you mentioned that you guys are looking to invest and you're looking at, real estate, you're looking at IP, you're looking at management teams. How often is it the case that you're looking at a business and you're noticing that from an operational perspective, there can be significant improvements and, some capital would be necessary to help turn things around? Does that go into the investment thesis at all? Or is that something that kind of comes after the fact once you've made an initial investment and kind of dug a little bit deeper into the circumstances?
We think there are always opportunities to support thoughtful management teams and business turnarounds. And, you really don't know the full extent of that until you get in and do your diligence. But that's why we like to have an open dialogue with the management team and look for opportunities where management and investors are aligned, and you can properly incentivize management to get there. So when we go in and do diligence on a situation, whether that's in our direct lending business or on the secondary side, there's always some good things and some bad things, and when you have the type of change that you do in retail in particular, you really need to dig through that opportunity and understand, what assets are available and what the opportunity set is. So, when we look at these situations and look at the constraints that we're under and that the business is under, we're trying to figure out how to optimize that opportunity, how to focus on the investments that have the most interesting return on capital, and set up a dynamic with the management team so that everybody is aligned and everybody's rowing in the same direction, and that they, that they're successful when the investors are successful. So I think it starts with, kind of a sober assessment of the situation and making sure that you're aligned with the management in that turnaround, as you said.
That's insightful. Thank you. So turning to a different topic and just kind of taking a step back and kind of understanding the landscape since we found ourselves in this pandemic in March. Back at the beginning of the pandemic, there were a bunch of retail companies that were trying to effectuate liability management transactions. And as a result of the marketplace changing, all of those companies were unable to consummate amend and extends or otherwise extend runways to avoid a restructuring. And they were all pushed into Chapter 11 cases. You can think of JCPenney and Neiman and J. Crew as a few examples. But then there were a whole bunch of other companies that were already in bankruptcy. And these companies were teetering on whether or not there was going to be a reorganization, a sale, or a liquidation. And think of Pier 1 and Models, all of whom were in bankruptcy and then literally had to mothball because of the environment in which we found ourselves. And ultimately, they needed to liquidate. So, Krista, as we think about liquidation sales, where sometimes it's an unfortunate reality of various cases, how have things changed? And how are people and advisors, analyzing recoveries in liquidation sales in a very uncertain marketplace and a very uncertain time when people, to your point, are doing much more shopping online, which makes it very difficult to liquidate inventory in stores?
I think, first of all, it obviously has been problematic with the pandemic. And I think what I will say is I've been almost surprised by how well the liquidation companies have done in forecasting. They have been astonishingly accurate in understanding what the consumer is thinking of different kinds of products. And they've done really great job in their forecasting this year. And I think where it's been a clear signal that they've missed is a couple things. Is we definitely can see changes in the store traffic patterns as COVID cases increase. There is a direct correlation. And we saw this. It's very more difficult to see now because it's more of a blanket acceleration in cases. But back when we started to see some accelerated cases in California and some other specific markets, we could actually track the change in trend on store traffic. And so I think that that's going to continue to be an issue at the end of this winter and in through early spring. And then the other thing I think they've been facing is this whole issue on apparel. And I think that that's going to continue to be problematic. There's very few people looking for a tie, high-heeled sandals, or a sparkly dress this year. And I think that estimating how much the consumer is going to be willing to pay for those products is going to very much continue to be an issue for them, even in partial or full liquidations.
And Julia, from your clients' perspectives, as you're looking at reorganization alternatives and banking a company go forward, plus the appraisals and where things are shaking out, from an inventory perspective, butting up against the leasehold deadline, how are ABL lenders evaluating reorganizations versus liquidations and ultimate recoveries?
Yeah, Josh, it's a great question. And I mean, make no mistake, we get into bankruptcy and a lot of times there's a black hat on the lenders and people are saying they're forcing this timeline. They want milestones, all of which is very non-controversial if you think about the entire thesis about the fact that you have a truncated timeline. But ABL lenders, like other lenders, make money by lending money. So, it's the rare situation where you're wanting to liquidate. That's really, you're in a recovery mode at that point. It's not really in an investment or lending mode. You're on the back end, not on the making money piece, which isn't where people want to be. So I think, people are interested, ABL lenders are interested in financing both dips because there's opportunities to protect your investment, make sure there's going to be a runway whichever way you're going, fees and interest associated with that. And then also looking at the exits. I think you do see a competitive market for those retailers that actually do have a cohesive go-forward business plan. These banks and other lenders are in the business of making money by placing their capital to work. And so you're looking at that. Now, to your question about the liquidation and how you evaluate it, I think if you're in a liquidation mode, you're evaluating it as exactly as I said, you're in close contact with your appraisers. And just to be clear, folks may know, but the way a liquidation is done within a bankruptcy, Josh says if the lenders want to liquidate their collateral, I can't actually liquidate it without foreclosing. What I can do is have milestones in place that require the debtor to take actions to do that if we get up against that. And then the debtor will go out to the major liquidators, all of whom are, as Krista says, expert at the appraisals, knowing the value, knowing how to drive the traffic in a very detailed type of way, and bid those out. So sometimes you'll have four major ones, maybe another player in the space competing. Sometimes they JV because there's just so much out there right now that they have their own liquidity needs and have to be able to be sure if they're committing their balance sheets, if they are able to do that in a variety of scenarios so they can play in all the different ones. And we as lenders, if we're in a liquidation scenario, like to stay in regular contact. It's great to get information from the company, but we also like it when the liquidators work with us. We do weekly reporting. Our lenders have a chance to ask questions to the liquidators. And the liquidators too, everyone here is an economically rational actor. They're playing for upside. So they're bidding in at a particular amount, but then they're putting in augment, which is, bringing their own stuff in to sell it because they now have a great chain or place to put it. And whatever they pay, they make the spread in what they're going to sell it for. So you're going to have, if I could just keep these in, I wish I had manufactured the AirPods. You're going to see the liquidators working with the lenders because they want to be the successful ones that get to do it again.
All right, turning to a less morbid topic, because I don't like really talking about liquidations. I just want to talk a little bit about technology. We've alluded to it multiple times today. It's the great disruptor. I think technology, frankly, has kept everybody in the restructuring community busy for the last 10 years, notwithstanding some of the best markets, that we've seen. But, Michael, from an investment standpoint, with the advent of Amazon and one-stop shopping where, Walmart and Target just make it easy for you to go to one place, how important is it from your perspective, looking at an online platform and an e-commerce business when you're looking at an investment in what would be a fragile brick and mortar retailer?
Yeah, I think online is very important, and most of the investments that we make in retail have a big online piece to them. And I think we have to acknowledge that, consumers are shopping online more every year. And in COVID, that has created even more of a step change in that purchasing behavior. A McKinsey survey that they conducted post-COVID suggested that, while online purchasing was already about 30%, post-COVID consumer purchasing is 10 percentage points greater now online because people aren't going into the store. And you already referenced the data point about 50% less shopping in store. That's all going online. So this is a very important piece of any investment. And as I mentioned earlier, having a successful online platform creates options for the retailer in helping to reorganize. So, like anything, successful retail is about providing something that consumers can't get anywhere else. And so thinking that you're going to compete with Amazon on price or on the quickest delivery is probably not a successful strategy. So you have to provide something that's unique, whether that's a service, a lifestyle view, or a product, and keep it fresh and valuable for the consumer to come back. And then finally, and this has been an important piece of investments that we've made, you have to have a footprint and location that still matters to people. People want to try on, touch and feel their purchases and really experience the full brand, which has made it difficult during COVID. While retail footprints are shrinking in many of these businesses, many of them still have very prime locations that will be valuable and that will be in demand for consumers going forward. So for both new business and existing customers. So kind of looking at the full picture of what the retailer is providing and the value proposition to the consumer is very important.
And to that end, Krista, so a question for you, because you guys are often on the front lines at the store level, helping companies with operations and trying to fix, what otherwise are antiquated systems and technology. How do you guys advise these companies on really getting transformed into the technological age? And how can you go about affecting that, in a relatively short term when you're dealing with all sorts of other operational issues, not to mention balance sheet concerns?
I think, I guess this is both the good news and the bad news, is I think a lot of retailers have delayed investments for so long that to some degree they've missed an entire generation of technology. But the good news is that now the software as a service and the different things that they can purchase sort of off the shelf and then use as service are really pretty, can have some pretty dramatic benefits and can be realized in a very, very quick period of time. And so I think this idea that there is this long, arduous implementation of technology doesn't necessarily have to be the case for some simple point-to-point solutions. And for example, pricing is one of those things that can be done quickly. Replenishment and forecasting can be done fairly quickly. And for some people that aren't so big, Shopify is a fabulous option if you have an antiquated platform. And so I think I talk to my clients about software as a service and doing things quickly to gain 80 to 90% of the benefit and not get themselves all tied up with, well, what about this one particular thing that maybe that service doesn't do so well?
That's helpful. Thank you. So we have a Q&A session, and I want to leave enough time for that. But I want to ask each of the members of the panel, one last question. And I think coming from each of their varied perspectives, it'll be interesting to hear the answer. And as we are all consumers and have the benefit of working in this community and this world and helping to turn around these companies, each of you, I'm interested to hear what you think the future of retail looks like. Will there be brick and mortar retail for dozens of years to come, or are we seeing a generational shift and complete transformation to what will be online specialized services and then one-stop shopping at the likes of Target, Walmart, and maybe ultimately Amazon if they start opening big distribution centers? But very interested in where you all think the marketplace is moving as we go forward. Maybe we'll start with Michael.
Yeah, sure. So look, I think online has continued the trend line for more adoption, and during COVID, as I mentioned, has taken a step change. Some of that will stick, and some will probably go back to trend line. But will there be brick and mortar in the future? I think there will, but I don't know exactly what path it's going to take. But ultimately, what we look for is strong brands that can survive, that have creative management teams, and ultimately, the companies themselves need a fortified balance sheet, and a balance sheet which is set up to thrive during this change. So while Amazon is a classic foil for any of these businesses and accurate, the companies themselves need to have the leverage profile where they can reinvest in their own business and create interesting opportunities and shopping experiences for their customers. So, and then as I mentioned in the last comment, I think location will still matter, and there will still be a place for customers to come in and experience those brands. And so brick and mortar, will continue to exist, but probably in a different form and in a different with a different footprint than it has historically.
Julia, thoughts?
I agree with Michael. I think that there will be brick and mortar. I do think that there is a craving by many consumers for getting back out, for touching things, for the shopping experience. I think that it's certainly nice to be able to buy things online. A lot of us are getting very online out at this point, and I do think there's a desire to be back out and to have that experience. I think one thing we haven't talked about is social media and the impact on retail. And I think we're seeing, particularly when I talk with the liquidators and how they're driving traffic, it's important not only to have your e-com platform, but social media platform. And we're seeing influencers drive people, the postings, on social media driving traffic. And I think, as you said, Josh, there's a generational shift. And even if kids, teens, a lot of folks who are going to be driving apparel purchases do want to get in the stores. They're doing that with a mindset as to what they're going to find there. And they're doing that largely online and through social media and TikTok and Instagram, and what they're seeing as being out there and new. I think the reduced brick and mortar footprint, which is absolutely going to happen, will lead to potentially developments in the commercial real estate market and, sort of a semi-crisis. I don't want to call it a crisis yet on that side, with empty stores, empty boxes, and thinking about how to either repurpose or change how those boxes are used.
And Krista?
All right. So I think I agree with everything everyone said up until now. I think a couple other things. I think the big players are only going to get bigger. Volume is very helpful in retail in driving synergies and low cost for the G&A line. So I think the big people are only going to get bigger. I do think that there's going to be a hollowing out of the middle. I think that there's a strong move to value in the U.S. and an equally strong move to great brand and luxury products. And I think the people that are going to be a little bit lost are the people in the middle from a price point perspective. And then lastly, I think stores are going to continue to be an important part of retail. Are they going to be what they were? No, but most direct-to-consumer brands can't survive in just direct-to-consumer. Most of them are thinking about what is my retail play. And so I think you're going to see a change in retail with new names. I don't know that we'll be shopping in the mega malls in the future. So I think that the way that stores are, the way that they present themselves to customers will change, but I anticipate that we're still going to have very, very vibrant high street retail, probably slightly smaller boxes, and I think we're going to see a lot of fresh faces.
I tend to agree with all that. So we left some time here at the end for Q&A, and there's been a few that have been posted. I am going to shout them out, and Michael, Julia, Krista, feel free to chime in wherever you think it makes sense. Some of these we've covered, but what is the future in the retail industry? Is it trying to return with customers at stores, or is the industry preparing for the online business? I think Krista, just answered that one really well. There will be a need for some semblance of brick and mortar retail, and the direct to consumer companies, per Krista's point, just won't be able to survive without it. And it's going to look different, but there will still be retail, and you'll still drive into town and see some stores. You may not go to the mall as much, but there will still be retail, all of which is, to be determined, and we'll have to see. Here's an interesting one. Which retail sectors are most vulnerable, and how, to any delay in widespread vaccine distribution and or delay demonstrated in vaccine efficiency? I would say, and you guys should all chime in, anything that is facing regulation and being closed as a result of the pandemic, i.e., gyms, movie theaters, restaurants, retail stores to a lesser extent. But, movie theaters literally are not getting distribution of new movies, and the theaters have been closed in many states. gyms remain a big concern, and there have been outbreaks at many chains, and we've seen bankruptcies for quite a few different gym companies. The longer this goes, and the longer it is until a vaccine is widely disseminated, the more stress and tension there will be, because these companies are burning a tremendous amount of cash just to maintain operations and keep the limited lights on. And it's only a matter of time before that cash liquidity runs out, and you're faced, your lenders looking at each other saying, what makes sense? And do we want to continue to finance the company on an out-of-court basis, or do we want to hibernate? So I don't know, Krista, Julia, Michael, your thoughts on that?
I mean, the other thing that I would say is important for some of these companies is that customers and consumers are finding viable alternatives. So just because the movie theaters aren't open doesn't mean we're not seeing new content. And just because the gym isn't open doesn't mean that we haven't bought something for the home that's replacing the gym. So I think that not only do they have this short-term liquidity issue, which is hugely important, but when investors think about the future, you have to kind of wonder if the entire landscape of demand has changed for some of those products.
Yeah, I think another point is that, as Krista said, the big will get bigger. And what you point out on closures, Josh, is the golden ticket of being deemed essential versus non-essential. So it's not that people weren't buying clothes during the pandemic. It's just that they can go to Target, they can go to Walmart, they can go to any of these mass distributors who, because they carry groceries and pharmacy and cleaning supplies, have the luxury of remaining open, where other retailers have been forced to close. So it's created a very uneven playing field in that situation. And I think on the reverse, if you see who is thriving because of this, we had several grocery stores pre-pandemic that were sort of teetering on the edge that found like a phoenix-like revolution because they were suddenly had the influx. They couldn't keep groceries in stock. So I think you're definitely seeing that impact, a bit of a shift in who can survive and who can't. And largely it's driven on whether you're allowed to be open and what, as Krista said, what your foot traffic is going to look like.
And Josh, I would just add a few others to your list. This is retail, but more broadly, you have the ecosystem of live events and entertainment, sports, all of the service providers to those businesses. To the person's original question, what will be affected if this continues or is slowed? I think, those businesses are under a lot of pressure right now. And while, when we get back to normal, they're actually quite good businesses. You do need that. You need that attendance and the willingness for people to come together in a social environment.
Yeah, I mean, it's almost a domino effect, and anything that's consumer facing, including hotels. Obviously people aren't traveling and they're stay-at-home orders. And so any business that thrives and relies on human interaction is, completely decimated at this point. And yeah, I mean, Michael, that point on live events and concerts and, art shows, whatever it may be, right? These companies are all severely hurting and very much need a vaccine to get in place so that we can return to normal, whatever that normal may be. One other question, and then we'll wrap it up. There was a question about whether eBay is facilitating liquidations. I don't know if any of us are qualified to answer that one. I have no idea, and personally, I've never been on eBay. But have you seen examples of retailers attempting to monetize their consumer spending data, and is there a market for that? That's actually a pretty interesting question, and I think consumer data and identifiable information is a very important piece of an overall restructuring. And sometimes we have a consumer ombudsman that gets appointed under the bankruptcy code to make sure that information is protected. But we have seen instances in restructurings where companies have databases of information and of customers. Just to give you an example, in Toys R Us, which also owned Babies R Us, you would have expectant mothers register at Babies R Us with a gift registry, and they'd give all sorts of personal data like date of birth, when the baby's expected, and then you know when the child's birthday is, and you can graduate them from Bye Bye Baby to Toys R Us. And obviously there's a story there that's meant for another discussion, but that type of information can be incredibly important to gathering intel and being able to get out to customers. So we have seen attempts at parties trying to get their hands on consumer information, actually purchase that. And it just needs to be done in a very concerted manner so that people's personally identifiable information is protected and we don't have a security breach. I don't know if anyone has anything to weigh in on that topic, but certainly a good question.
Yeah, the only thing that I would say, Josh, and I think is important, is that getting new customers is the most expensive cost retailers face, is customer acquisition. And so whoever asked this question has certainly identified probably the biggest asset that many companies have, which is understanding who their current customers are. So it's a very important part of, from a business perspective, the assets of the company.
Great. Well, Krista, Julia, Michael, thank you guys very much for participating today. I think it was a very well-informed discussion, certainly a topic that people are very interested in because it is part of the conversation and it seems as if it's changing on a daily basis. So thank you all for your time. I know everybody's very busy and it's been an honor and a privilege to participate. So I'm going to turn it back to Harold.
Thanks, Josh.
Okay. Well, Josh and group, thanks a lot. That was a tremendous presentation from some of the real experts in the area.